Hi, I'm Sapan Ghai, Chief Commercial Officer of Sovereign Metals. Sovereign Metals is developing the Kasiya rutile project in Malawi, which is the world's largest rutile deposit, the largest ever discovered. And we are developing that for the titanium dioxide and titanium industries. Alongside the rutile, we also have a graphite byproduct, graphite being quite important for the electric vehicles industry as we move forwards with the green revolution.
Sapan, good to have you back on, man. Good to have you back on the team. Now, you've just come back from Malawi, doing a little site visit. I want to get an update from you as to what you were doing out there, for sure. But I couldn't help notice a tweet the other day. You got a mention at the UN from the president, Chakwera. That must have been a bit of a surprise.
Yeah, no, that was very nice. Look, the president was giving his address at the General Assembly at the UN in New York, and he was obviously explaining the importance of private investors coming into Malawi in the agricultural space, and he also mentioned the mining space, and within that, he said, Malawi is now host to the largest rutile deposit ever discovered, which is, of course, our Kasiya project. So that was nice to have a little plug at the UN General Assembly.
Not too bad.
Yeah, not a bad stage to be talked about on. But yeah, look, I came back from Malawi just last week. We've been out there with consultants who are looking at everything from hydrogeology all the way through to some of the more core community initiatives that we're doing. But essentially, it's all part and parcel of the work that's feeding into the PFS. Also, it was a good opportunity for us to take a breather and reassess where we are as a company. We have grown quite significantly over the past 2 to 3 years, from a graphite exploration and development company into having the world's largest rutile deposit, or as I like to say, we tripped over the world's largest rutile deposit, which there's no doubt will be just hugely disruptive to the titanium industry and the titanium dioxide industry. So, we had to take a step back, make sure that we're no longer that small exploration company, but we are seen to be this developer.
Yeah. Okay. Well, look, I want to dig into that a little bit more, but it might be worth let's just step back and remind people what it is, just in terms of headlines for people new to rutile, new to graphite, and new to Malawi, because you've tripped over the rutile component, but this is shallow, very shallow, kind of like blanket deposit that you're looking at, and you do hydro mining. So give us the kind of like the 2-minute version of what your company is looking to do.
Yeah, sure. So yeah, you're right. Kasiya, from a geological perspective, is like a blanket over an extensive area covering about 180 square kilometers. So it's pretty huge. And within that area, there are high-grade mineralization areas of rutile, sitting anywhere between 3 and 5 meters below surface. Literally, if you walk on the ground and you use your boot to scrape off the soil, you're looking at the mineralized material. You mentioned hydro, so yes, what we're looking at is very simple mining of that, which is called hydro mining. Essentially, what that is a high-powered jet targeting the material. The material then creates a slurry with the water, which then gets pumped to a plant. In the plant, the rutile and the graphite are separated, and everything else is essentially put to the side, I guess, is the easiest way to put it. But then we put the heavy minerals concentrate, which includes the rutile, through a mineral separation plant, which is essentially a big magnet. Rutile is non-magnetic, so that falls out and isn't captured by the magnet, and essentially That's our end product on one end, and we've got the graphite on the other end. So, rutile, today's price is $2,500 a ton. A basket price on graphite anywhere around $1,000 a ton. So having the largest rutile deposit and one of the largest graphite deposits built within that is not a bad gig.
It's not a bad gig. It's super impressive margins as well. But so I want to discuss the sort of implications of that. The hydro mining means that the actual mining costs are negligible in this. It's all about the sort of infrastructure, the plant, and for both the rutile and the graphite. And so that's really around the engineering on the surface, as it were, that you're dealing with going forward. So can you tell us where you're at with that? Because I guess the big concern for investors right now is clearly the economy. It's clearly then going to be on, return on capital invested by you guys. And I want to sort of understand right now your decision making around how you allocate your cash, or how you best see the allocation of cash in a market like this.
Yeah, so look, we put out an expanded scoping study back in June to give some kind of headline figures around what you were talking about. And you're right, the capex. In terms of operating costs, we are at the bottom end when it comes to graphite, because essentially the graphite is a co-product. It falls out, and either we store it or we sell it. So it makes complete sense that we sell it. On the rutile, because we're using hydro mining, because the infrastructure is already there in terms of railroad, port, etc., is already there. So we're not spending any money on that. Really, it's that kind of non-processing infrastructure. So we are looking at having, a solar farm next to us, so we can bring down some of the CO2 emissions of just using diesel-generated power. It is just connecting ourselves to the local hydro grid. And yes, as you said, hydro mining isn't a very costly capex number either. So yeah, we're looking at around $330 million of capex for an MPV of around 1.6 billion. And look, this project, you can look at it on an MPV, but the size of it means that it's just multi-generational. So if you start looking at it as a production company rather than a mining company, and you look at your EBITDA numbers, we're talking about EBITDA numbers around, well north of $300 million a year, off the back of a $300 million initial outlay.
Right, which brings me neatly onto the question of how you value companies now. I guess the running joke within these types of interviews that CEOs come on and tell me, no matter what the economic conditions are out in the world, they're undervalued, right? You kind of hit upon something. You're an ex-markets guy. Me too. We don't look out further than kind of 10 years. You've got a multi-generational, multi-decade project in front of you. Lay out the case for me, in a little bit more detail than you've just done, how one could value a company like this.
Yeah, look, the normal thing with a gold company with about 10 years of life is obviously to look at the NPV and how that is versus the current market cap. With a project this size and how important it is within the entire kind of titanium world, an easier way to look at it is just in terms of EBITDA numbers, right? And kind of cash flow that's falling out of it. And as I said, you're talking about a $330 million EBITDA per annum. And that's over, according to our scoping study, that's over 25 years. But our scoping study only accounts for about 30% of the resource. So hence why, if you look at it on a per year basis, once this thing's producing, $330 odd million versus, today's market cap of about $100 million. So we're about a third of annual EBITDA just on the face of it. Now, given that in a normal environment, we'd expect anything to trade 6 to 8 times EBITDA. What are we? 4%? Our market cap is 4% of our potential value out there, which, is everyone saying that the macro environment, the price environment, and all the risks associated with mining mean that you knock off potentially 96% of the value of this project.
Right, and then let's stretch that a little bit further. Okay, the other thing that happens when, look, we're going to make a sort of quantum leap here from, you're going through the phases in terms of the economic studies and the engineering at the moment. We talked in the past about how this thing gets into production and what it can mean in the global economic market for rutile and graphite. But let's do that quantum leap through. This thing gets up and running and is running at or near where you think it can in terms of annual production and cash flows. How do I view that company in terms of what it does with its cash flows? Because big mining companies tend to plow it back in the ground, right? Because they go search for the next thing. You've already got the scale. It's the world's largest, right? It's the world's largest. World's largest anything is usually a good thing. So how could investors view you and what you're going to do with this cash?
Look, it's for the first 3 years, it's very simple. If we go via our scoping study, those first 3 years of cash flow get ploughed back in to the project to go from a 12 million tonne per annum operation to a 24 million tonne per annum operation. So we double everything on the ground, right? You double the size of your plant, you double the amount that you are mining, processing, and essentially you double the amount that you're producing, which the market can very easily take, even in today's context, today's market context. So then the question arises, well, what do we do once everything is up and running and we're in steady state with those cash flows? And yes, obviously, like any other mining company, you'd use part of it for exploration and proving up the resource, so that in 40, 50 years time you're there. But I mean, look, if it was a standalone project, you'd start looking at dividend policies and how shareholders basically get a return on their cash invested.
Right. Okay. That's where I wanted you to go, because I think people want to know, how to view this company as an investment. Could this be a dividend stock for them? And let's look at some of the other reasons to kind of maybe discount that story. So that's where it could be, and those numbers are where it should be. Given what's happening in the current market at the moment, we've disruption to supply chains. We've got sanctions associated with Russia. We've got huge kind of nervousness about what economies are going to be doing after all of that printing of money, which seemed quite good at the time. What does that do for rutile market, for titanium market, for graphite markets, as far as you're concerned? And are you taking any measures to protect yourself, to make yourself defensible there, or is your expectation something else?
Look, the first point I'd make is in all of our economic studies, all of our scoping studies, etc., we've always been very conservative on the pricing. Rutile has had quite a nice run over the last 2-3 years, trading at anywhere between kind of $2,500 per ton to, anecdotally we're hearing $4,000 a ton for very premium grade rutile. What do we use in our own models? We're using something like $1,300 a ton, so way off there. And the same thing goes for the graphite. You have, we have access to where graphite basket prices could be given the increase in use of electric vehicles, et cetera, in the future. And, they're anything up to kind of $4,000 or $5,000 a ton. We're using $1,000 a ton in our model. So again, we're being very conservative on that front. So we're not exactly massively worried about the current environment, the effect, and any kind of squeeze that could give, both on the cost side and the price side of our financials. In terms of the current outlook on rutile and the titanium world, look, 50% of aerospace grade titanium came out of Russia, and now look, if that doesn't come back online and people in the West aren't buying it, they're going to have to look elsewhere to buy it. And currently, they're going to Japan to buy that. And there's two big aerospace grade titanium producers out of Japan. It wouldn't have you would have noticed that we've got an MOU with Mitsui, who are one of Japan's large conglomerates and one of the world's largest traders. And obviously they trade rutile into Asia. So we've signed a non-binding MOU with those guys at this stage. And look on the Western front, if you want to speak about that, you've got some of the pigment producers who are saying, look, we're going to pare back our guidance in terms of our own financials over the coming months. But the guidance in terms of the years and expectations and forecasts over years and by the time we're in production, pretty much are pretty stable, regardless of the current climate. And look, I do want to add just one extra thing, which is some of the pigment producers have lowered their guidance, and they've lowered their guidance mainly due to energy prices in and around Europe and Asia, which we're all very aware of what's happening there. Now, the nice thing about rutile is that it's one of these direct use products. So it doesn't have all that energy intensive upgrading requirement that, some of the ilmenite based products will and do need. So, shifting to rutile is a solution in a high energy price environment.
So give me that again. Tell me, break that down. Why?
So look, rutile's 95% TiO2. That gets directly used by the pigment producers to produce pigment. Ilmenite, which there's a lot more of and is obviously the more abundant material and therefore the easier to get a hold of, at least prior to the discovery of Kasiya, is anywhere between kind of 40 to 60% TiO2. So it needs to be smelted and all the rest of it, or put in a kiln and roasted in order to get around 85 to 88% TiO2, which is still nowhere near the kind of 96% that we're throwing out from Kasiya. So, we skip that entire smelting and roasting process that pigment producers are having to buy out or use in order to get their supply.
Got it. Okay, just wanted to be clear about that. Let's go back to the realities of today, right? So cash is king in markets like this, gives you optionality. Where are you with your cash? You're in the middle of a PFS process. You flew out recently to work with some show some consultants around. You're going through a phase where you're going to, well, I guess that the money demands aren't huge, but have you got enough to kind of see you through to the end of the PFS? What do you do about raising capital, and how would you view raising capital in a market like this?
Yeah, so look, we have we raised the last raise we did. We raised around $15 million, and that was back in June, just before the markets did what they did. So I think a few weeks later, the entire market was red. So pat on the back for us in terms of raising money when the markets were good. And the bulk of that is being used through the PFS, and we'll probably come out the other end of the PFS, which is due in Q2 next year, with maybe a little bit of buffer cash, but we're not stopping anything. We're not taking a back seat. We're not slowing down. This thing is just speaks for itself, and shouldn't, we can't sit on what is essentially such a transformative project. So we're pushing ahead with the PFS. That'll give us, and that'll give the market, hopefully, and give our investors a lot more confidence around the potential of our project.
Right, and well, what's happening at the moment? It's interesting actually, because what's happening at the moment is that companies that are putting out studies at the moment, there's a kind of shrug of the shoulders, really. It's kind of like, so what? We're super nervous about the economy. We're more nervous about the economy than your amazing numbers that you're putting out. And some companies choose to hunker down and say, well, if you're not impressed by that, and you should be, we're going to kind of stop until the market works out how it feels about anything. Or some companies go, well, actually, I am going to raise capital now, and it may feel expensive right now, but in terms of the value that it will release when the market comes back, this will seem like cheap money. So where's your head at in terms of how you manage those choppy waters?
Yeah, look, we as with any public company, you know, we're essentially a function of what's going on with the macroeconomics, and therefore what's going on with our share price. And there's as I said, there's no real rhyme or reason for us to be slowing down internally. So we're going to continue on the current path. In fact, as you know, while I was in Malawi, as you mentioned, we were taking hydrogeologists and the likes around the project. We were continuing with a lot of our community initiatives and not giving up on any of those, just because the macro environment currently, and you know, let's be honest, the political environment right now is a bit unstable. But we're all very sure, you know, we were all very sure things were going to be great 12 months ago, right? So who knows where we're going to be in another 12 months? If anyone does, I'm happy to pay them for extra advice, right? but for now, I think we're not chucking money out of the door, but we're not being ultra conservative either. We're being prudent enough, but making sure that we stay on track and deliver as we you know, promised our investors that we would deliver into next year.
Okay, and what are you getting back in terms of information from partners or, you know, stakeholders, not just investors, but people, say Mitsui, for instance, you know, big organisation, fingers in many pies, and what are you hearing from them? What's the expectation of you? And it's only an MOU, but you must be talking to them. Yeah,
look, the reality is, and we were having discussions with a potential off-taker only this week. Everything from any of the third parties further downstream is don't stop, right? We don't see any reason for this to stop. We all need rutile. Rutile is very important. I mean, look, even if you believe that the macroeconomics may depress the titanium industry or the titanium dioxide industry, that doesn't stop the fact that all the rutile deposits in the world right now are either depleting or lower grade or need more cash to go into sustaining where they are. And so, you know, you're looking at around a 60% decrease in rutile supply from its peak in 2017 to the point where we turn on Kasiya. So, you know, even if we came into market at full blown production, we're only making up about 30% of that 60% drop. So there's really no reason. From third parties, the understanding is there's no reason for us to stop discussing offtakes or put the brakes on or anything like that.
Right. Okay. Well, like Sapan, I appreciate you coming on today, and you know, I just wanted to, you know, see how excited you were from the site visit, because the site visits are, you know, quite revealing in the sense that consultants looking at this thing go, well, this is going to be a tough one, or this is actually better than I thought. You know, and it'll be interesting to sort of see what comes out of the company in the next few weeks and months. And I'll just say also thanks for the images that you've supplied that we've kind of sprinkled throughout this conversation, because you're getting down to the hard yards now. PFS is due before the end of Q2 next year. Is that right?
Yeah, before the end of Q2 next year.
Okay, brilliant. Okay, well, appreciate your time. Stay in touch. Okay.
Perfect. Thanks, Matt.